If you've set some money aside, if you have saved a bit, if you've got some capital to invest, you are facing a problem in this market because everything is up. Bitcoin is up, the stocks are up, gold is up, property is up. What can we buy in order to escape inflation and not get crushed in case this is all just a price bubble? In this video, we are trying to answer that question, and we're not just going to answer this in a generic fashion. We're going to look at specific ticker symbols that you can buy today. But let's first have a look at the landscape. This is Bitcoin long term, and we know that it recently made an all-time high. It's definitely not as cheap anymore compared to 1.5 years ago. Bitcoin went up by more than 4x. Here's a long-term chart of stocks, to be more specific, of tech stocks. So this is NDX, the Nasdaq 100. And here as well, we are very, very close to all-time highs. Only 5% from that high. Here is gold, also very, very close to all-time highs. Also does not look very cheap at all. And here's the US housing index. We see a little bit of a correction, but still, historically speaking, we are at high prices. Now, the issue is that we don't want to just keep our cash on the sidelines, right? We want to have our capital somewhat productive. At least we want to escape inflation. Now, there is one asset class that got absolutely destroyed recently, and very few people have eyes on that asset class, and that's long-term US government bonds. Now, I'm not a fan of bonds in general because usually monetary expansion is faster than what you can get with the bonds, right? US M2 expands by roughly 6.5% per annum over the decades. Usually bonds don't pay that much. And so just having a 60-40 portfolio, as it was taught back in the days, right? 60% stock, 40% bonds. I don't believe in that. But I believe there is a chance in bonds now, specifically in long-term US government bonds. And let me show you what I mean. What we've got over here is TLT. So that's the iShares 20-year plus Treasury bond ETF. So it's an exchange traded fund that holds Treasury bonds with the duration of at least 20 years. And this got absolutely decimated. The value of that ETF went down by 50% roughly. Now that's kind of counterintuitive, right? Most people say that bonds are the safe investment vehicle. Why do bonds suddenly crash like this? The answer is interest rate risk. Or in our case now, interest rate opportunity. In other words, the value of a bond is the sum of its future cash flows. So you hold a bond, you get the coupon payment every year. At the end, you get paid back the principal. And the longer the duration of that bond is, the more you have to discount those future cash flows. So when you've got short-term government bonds, the interest rates don't really change the prices of those bonds that much. If you've got long-term government bonds, then when the interest rates go up and the price of the bonds go down, and vice versa. The reason for this price drop is 100% in this chart. We went from pretty much zero interest rates to now 5.33 effective funds rate. The increase of the interest rate by those 5%, because we are dealing with very long-term government bonds, more than 20 years, that increase crushes the prices. Thus, if we expect that at some point the interest rates could come down again, which I believe is not a totally unreasonable expectation because currently interest rates are higher than the inflation rates, even the officially measured inflation rates, since we are now officially in monetary tightening, at some point, especially when there's any kind of pressure in any system, be this the financial system, be it the property system, whatever it is, if there's some kind of bailout needed, then maybe those interest rates could come back down again. This is usually how it goes. We get monetary tightening, then comes a crisis, then interest rates get slashed. And when that reduction of interest rates happens and the economy is doing poorly, then stocks are probably going down. Bitcoin might go down a bit as well. Who knows really what will happen to gold? Property is also hard to anticipate. It depends how much the property market is involved in the future crisis. But the thing that will definitely go up when interest rates go down, that's long-term government bonds. And so I had a look at various ETFs to potentially purchase. We've got TLT over here. This is SPTL laid over. We can barely see a difference here. So SPTL is the SPDR long-term treasury ETF. We've got VGLT, also very similar in performance. But then have a look at this. This is TMF, so this purple line over here. It goes up much more when interest rates are falling. It goes down much more when interest rates are rising. And so if you want to bet on falling interest rates, this is the ETF that I could find has the most price impact. So that's the Direxion Daily 20-year plus year Treasury Bull 3X shares, ticker symbol TMF, and the expense ratio unfortunately here is very high. And so this is only an instrument that makes sense to hold if you want to bet on those falling interest rates short term. Because have a look at this, right? This is a comparison chart when all the other ETFs were pretty much just going sideways from this point to this point. The purple line over here went actually down by 27%. So in the span of roughly 7 years, this ETF burned 27% in financing fees. So be aware of this, right? Don't hold this for the next 5 to 10 years. Only hold this for short-term trading. Of course, as a diversifier, if you're currently highly exposed to crypto, if you're highly exposed to stocks, and you do want something that could outperform in case we suddenly see a crash, right? This video is sponsored by the Premium membership. I never take any money from any crypto project. I never take any affiliate links from centralized exchanges. I never pump and dump coins. Instead, I offer valuable tutorials in the Premium membership. Feel free to check it out. This is the art of asset diversification, right? You want to have something that's as negatively correlated as possible, that in case one of the assets goes down, you've got another asset that might be going up, and then you can rebalance your portfolio, right? You can take advantage of those low prices by buying with the asset that went up. So in other words, you've got something on the sidelines like this long-term ETF that could then go up a lot in price, where you can then buy a potential crypto crash. Now the issue with TMF is again the financing costs. And so this is really just a short-term instrument. You do not want to hold this over many years. And this makes diversification a bit of a problem, right? It's more of a hedging ETF rather than an ETF for long-term diversification. Here is the ETF that I like most. It is ZEROS, so that's the ticker symbol over here. It's the PIMCO 25-year plus zero coupon US Treasury Index ETF. So zero coupon means that all of the payment will happen in at least 25 years in the future. So there's even more interest rate risk here, or interest rate opportunity, however you want to see this. And that's the second purple line here. So let's get rid of TMF. Let's have a look at ZEROS and see how this is actually not losing when we are just flatlining. This is simply just a bit more sensitive to interest rate movement. The expense ratio is 0.15%, so it's very cheap. And again, when this line here goes down, or when people anticipate this line to go down, then this ZEROS ETF will shoot up. How much will it go up? Let's say we revisit the old highs. Let's say we go to 0 interest rates. The price increase could be 160, maybe almost 170%. So this is not your boring bond position. This is a position that will profit massively and hedge you massively for all your other positions you might potentially have. I'm not saying to shift all of your assets into bonds, but I am saying it always makes sense to have a diversified portfolio to be able to buy the dip. If your current wealth is relatively high relative to your income, then if it dips heavily, your income won't be enough to take advantage of the dip. Once you've got more than 2 or 3 years of income saved up, you've got that in liquid wealth, you have to be somewhat diversified, because otherwise when it crashes, you can't do nothing. You can't really take opportunity and you can't really outperform the market. Make sure you've got something to buy the dips. I don't know when those dips come. I don't have a crystal ball either, but I know at some point something will happen. There's no way that we're going to continue to go up in all asset classes all the time. You want to be diversified across different asset classes, and bonds, especially long-term US government bonds, is the asset class that's currently the most depressed. If it's your first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. There's also a free Telegram. Link is down below.